Hi everyone, welcome to our session today. My name is Mitema Emmanuel and I'll be taking you through equity investment analysis. So this is a topic or rather a subject in CIFA, that is intermediate level. And so I see you are going to start it. So what is equity? What is equity? Equity is the ownership claim on the company's net assets. This is ownership claim on the company's net assets. And we have different types of equity. I think in our subsequent lectures, we'll be looking at those types of equity. We have like the preference equity, the common, which is called the common stock or the common ordinary shares. Also, we have, now we find that a scenario whereby this equity is traded in an equity market. So what's an equity market? This is rather a venue or it's an institution where equity is traded. So equity market is where securities are traded. This is where equity securities are traded. Remember, when I say securities, we have different types of securities. In this scenario, you are looking at the equity securities. But again, in more advanced, in other advanced courses, we will be looking at types of securities. But if I can mention them, we have what we call the bonds. These are also some securities. We have derivatives. Under derivatives, we have different types of derivatives. We have what we call the futures contract. We have forward contract. Again, we have what we call the swaps. We have the options. And even options, they are divided into various groups. I think when you, in the advanced level, when you'll be taking a course called derivative analysis, you'll be able to look at this in more detail. Also, we have other types of securities like treasury bill. Treasury bills. You have also other securities are like commodities. We have many other, but now here we are looking at the securities in terms of equity securities, and we have said that equity is the ownership claim on a company's net assets. And this claim probably comes when the company is paying in terms of dividends or when a company is going into liquidation. So liquidation is when a company decides to sell all its assets, including the common stock, in order to pay its creditors in terms of priority. So you find that if it's in a liquidation and the company is able to sell all its assets and stock, it has been able to pay all its creditors. Now the remaining money or assets are claimed by the equity shareholders. So the shareholders have a claim on the company's net assets. So, and I would say that equity market is a venue or institution where securities are traded, and we can, from here we know that it can be in exchange traded or can be over the counter. These securities, or these, including the equity security, they can be traded either in exchange trade or over the counter. Now, in the equity market, where the securities are traded, in Kenya, for example, we have the Nairobi Stock Exchange, where it's an institution that facilitates the trading of securities. It could be equity securities or even these other securities. Again, so you have different purposes of equity. Purpose of equity. One, of equity. One is this. One purpose of equity serves as the ownership claim on a company's net assets. And I think I've been able to explain what that means. Number two, it can be a source of finance to a corporation. Also, it can be perform a financing role from internally generated funds or the retained earnings. So number one, we said it represents ownership, institutional ownership. It can be source of finance, more especially when it's a new issue. And now this is when a company goes to what we call IPO, initial public offer. When it's going public for the first time, if it was a private company, it raises some finance. It's a source of finance or capital for a company. Find that most companies, therefore, their capital structure is either, actually it's debt and equity. So when a company goes for an IPO or any issue, it can generate some finance or capital from that IPO. And then number three, it states that it performs a financing role So it performs financing role from internally generated earnings. What is commonly known as retained earnings. So you find that the whole transaction of equity securities, they are facilitated in a financial system. So for all these transactions to take place of equity securities and even these other securities, there must be existence of a stable and well-functioning financial system. Financial systems are, we have different financial systems. We have even the banking system, the investment banking system, the insurance companies. All these are financial systems. So what are the roles of financial systems. Number one, they save money for future use. Savings. Number two, borrow money for current use. You can go to a bank, you borrow money to fund your project or your transaction. If you want to buy a car, you can go borrow some loan under certain interest to facilitate your current use or transaction. Number three, another very important role of financial systems is that they trade on information in terms of their financial advisory. And number four, they do what we call analysis of risk. This is where they look at the risk exposure, they analyze it, and even develop mechanisms on how to mitigate the risk in the future. Again, number five, is that they raise equity capital. You find that when a company is going for the IPO or for a new issue, they usually liaise with their corresponding maybe investment bank to enable them issue their IPO. This is where we have the process of an IPO. I think again we are going to cover it in our subsequent lectures, whereby the investment bank does their underwriting and valuation of the share, market share, and then they issue it. So they raise capital for a company, more so when it's going for an IPO, that's initial public offer. Also, you have said they manage risk. So let us look at different types of equity securities. Types of equity securities Number one, we have what we call ordinary share, stroke, a common stock. Number two, we have the preference shares or the preferred stock. Preference shares stock, the preferred stock. So these are the most common types of equity securities that we have. And each security has its own features or its own characteristics. So let us look at the common shares. So the common shares or the common stock or the ordinary share, they are the most common form of equities that we have. These are the ones that represent ownership. So the common share, not the ordinary share, stroke the common share. So you have said here's the most common shares that we have. And number two, you have said that they represent the ownership. So represent ownership. Again, the common stock or the common share, they have what we call the voting rights. Voting rights. Maybe you can vote in a new executive. So again, the common shares have what we call a ratio claim on firm's asset. If the firm is liquidated, I think I was illustrating that point earlier, when a company goes to liquidation, so we have what we call the residual claim. Residual claim when a company is going into liquidation or when a company is being liquidated by a liquidator. So again, firms have no obligation to pay dividends. So they are not, yes, dividends are there, but they are not under obligation, no. So no obligation to dividends. Unlike other types of shares, more so in the preference shares, where that there's an obligation pay of dividends by in terms of a fixed income that they get. Lastly, as I said earlier, the common shareholders, they have what we call the voting rights. They can vote. Maybe they can vote in a new director or board of directors. So under the common shares, we have two types. So common shares, they are also subdivided into two. Number one, we have what we call callable, and number two, you have what we call putable. So we have callable common shares, and putable common shares. So what does that mean? For the first one, which is the callable common shares, these shares give the firm the right to repurchase the stock at a prescribed call price. You find that a company can decide to repurchase back its shares from the investors at what we call a prescribed call price. So that's why they are callable. The firm has the right to repurchase back its shares from the investors at what we call a call price. So the investors, they will receive what we call a fixed amount when the firm calls the stock. The investors will receive a fixed income when the firm calls back or is stock from the investors. Number two, what we have called the putable common shares. Putable common shares, they give the shareholders the right to sell the shares to the firm for a specified price. They give the shareholder or the investors the right to sell the share stock, or the shares to the firm at a certain price. They can agree at what price? Maybe the most favorable price at the market, so the firm can buy the shares from the investors. The investors are the one who are willing to sell the shares back to the firm. So let us look now at number 2, what we call other type of equity shares, which is the preference shares. Preference shares. So what are preference shares? So preference shares, these are the shares that have both features of the common stock and the debt. They combine features of the common stock and debt. Why so? Because you find that the people who are preferred shareholders, some of them, they enjoy the same rights that the common shareholders enjoy, but on top of that, there's an issue of debt. And you find that in these preference shares, you have different types of shares. Some of them are redeemable, some of them they are not redeemable, some of them are convertible. So you are going to look at those categories. But first of all, preference shares, they have a combination of features of the common stock and the debt. So, as with the common stock, preference shares, dividends are not a contractual claim or an obligation. And in terms of the debt, they have a maturity period. So let us look at the types of preference shares. And here, before we go to the types, there's a fixed income or a fixed payment that is made to the investors, So that is more like that's this aspect of the debt. So types of preference shares. Types of preference shares. Number 1, we have cumulative. So we have cumulative preference shares. Number 2, we have non-cumulative shares. Number 3, we have what we call convertible shares. 4, we have non-convertible shares. 5, we have what we call redeemable shares. Number 6, we have non-redeemable shares. Lastly but not least, we have got participatory preference shares. Participatory preference shares. So these are the categories of the preference shares. You have cumulative shares, non-cumulative shares, you have convertible shares, non-convertible shares, you have redeemable shares, non-redeemable shares, also you have participatory shares. All these shares, they have different features. That's why they are different. So before you invest in a specific type of a share, so there are those features that you need to look at before you do so. So let us look at the different features of cumulative and cumulative convertible shares. I will erase this side, hoping you have finished to copy for those who are taking notes. So, number one, under cumulative shares, you find that they are usually promised fixed dividends, and any dividends that are not paid must be paid before common shareholders can receive the dividends. So, cumulative shares, I've seen, so they are promised a payment in terms of dividends. And if there is any dividend which has not been paid, it is paid before the shareholders are paid their dividends. So, you can say unpaid dividends are paid before shareholders. So, not, okay, let's say none paid dividends are paid before the common shareholders. They must be paid first before the common shareholders are paid. That's why, if you can remember here, we say that the common shares are not, they have no obligation to payment of dividends. And let us look at number two, the non-cumulative shares. So they do not accumulate over time. When they are not paid, so they do not accumulate over time, and when they are not paid, but dividends for any period must be paid before common shares receive the dividends. So here, they are not accumulating, but for that payment of a fixed payment of dividends for a certain period of time, it must be paid before the common stockholders. But the other aspect, they accumulate. The unpaid dividends, they accumulate. And when they accumulate, they must be paid first before the common shareholders are paid their dividends. So let us look at convertible and non-convertible shares. So convertible preference shares, so in here we have said that you have to look at the non-cumulative, say that dividends, do not accumulate over time, but the fixed payment of dividends of a certain period must be paid first before the shareholders are paid their dividends. And number three, looking at the convertible, and we say that the convertible preference shares, this is where these preference shares, they can be exchanged with common stock. Find that the convertible preference shares, the shareholders with this type of shares, they have the right to exchange their preference shares with the common stock. The usually is done through what we, there is always what we call a conversion ratio. It can be 3 to 2, depending on the market. This ratio is the one which they use to convert these preference shares to the common stock. Somebody would like to be, why will someone like to convert the preference shares to common stock? Probably would like to enjoy the rights that the common shareholders are enjoying, like the voting rights and the institutional ownership of the firm, or it could be there is their common stock is of higher value. Maybe their market price per share, it is going up, and probably the company is making profit. The profitability of the company is really good. So a preferred shareholder who has these convertible shares could change them for common stock. And then number 4, you have the non-convertible shares, preference shares. Is the opposite of these. These shareholders don't have that right to convert their preferred stock or shares to a common stock. So we are done with that. Let's look at the what we call redeemable and non-irredeemable or non-redeemable shares. So these are shares that have a maturity date on which the original sum or amount of which was invested by the investor is repaid. So the redeemable, number 5, you have redeemable shares. We have said they have what we call the maturity period. And when the date reaches the initial sum, so initial, can call it initial sum or outlay that was invested is repaid to the investor. They have a maturity period. Now, this is where, if you can remember when we have defined the preference shares, we said they have what we call the features of a common stock and the debt. Now, here is where these types of redeemable shares, they are like a debt, because there's this aspect of maturity period and the initial sum which was invested is repaid to the investor. So it's more of a debt, kama deni. And then we have the irredeemable shares. Irredeemable shares, that's the opposite of redeemable shares. They do not have a maturity period. That's number 1. They do not have a maturity period. And then the issuer may be paid or may repay the dividends forever. We find that in these redeemable shares, the dividends are paid to a certain period, this maturity period. But because the irredeemable or the non-redeemable, say irredeemable shares, they don't have these. First of all, they don't have maturity period. Secondly, the issuer, that's the firm, can repay the dividends forever because there is no that aspect of maturity period. And then let us look at what we call participatory preference shares. So this is where you find that the investor receives extra dividends if the firm proceeds exceed a predetermined period. These types of shares, number 7, the investor receives more dividends when the company's profitability increases. The investor who has those kind of shares receives an extra dividend when the profitability or the proceeds of a company goes beyond the predetermined level. And then we have the non-participatory kind of shares. They do not receive extra dividend. It's just the opposite of the other one. They do not receive any extra dividend. So let us look at the advantages or the benefits of preference shares. Benefits of preference shares. Benefits of preference shares. So number 1, we find that the dividends under the preference shares are higher than the common stock, because you find that in this type of when the profitability of a company goes beyond the predetermined level, that aspect of they get also extra dividends. So number 1, say preference dividends they are higher than those of the common stock or the ordinary shares. So number 2, this aspect of conversion, we say that in terms of the people who or the shareholders in the convertible preference shares, they can change or exchange their shares to common stock, and by doing so they'll be enjoying the same rights as the institutional ownership of the firm, plus even the voting rights of the same features that the common stock enjoys. So you can say that the conversion option becomes more valuable when the common stock prices increases. So the conversion option is valuable when the value of the common stock increases. Common stock value increases. Number 3, we can say that they have a lesser risk compared to the common shareholders. You can say that they have less risk exposure compared to preference shares, because for those like the ones which one is that? The one which is redeemable, you can, when you are repaid and then the company maybe its profitability decreases, then your value of money is not really affected. And then the firm, also number 4, you can add that the firm, if the firm is profitable, the investors can share the profit by converting their share to common stock, as we said in terms of the preferred shareholders. So let us look at different types of, we have public and private equity, the difference between the two terms, public and private equity. Public and private equity. So what's public equity and what's private equity? Or what is the difference between the two types of equity? A public equity is a form of an equity investment that is traded through recognized markets. This is a type of equity investment, public. Equity investment traded in recognized institutions. So you find that since it's public and it is publicly traded, then there are very for public investments, and you find them in stock exchanges. This type of equity is usually found in stock exchange. We have the New York Stock Exchange, New York Stock Exchange, we have Nairobi Stock Exchange, Chicago, there are several of them. So that's where you find public equity. Now let us look at the private equity. So this is where institutional investors trade. So you can say it's usually issued by institutional investors in what we call a private placement. So private equity is issued by institutional investors in a private placement. What we call private placement. So the form of equity issue here is not traded publicly, it's private. The issue of this type of equity is not traded in public, it's more of a private transaction between institutional investors. It can also be even individual investors. Now, what are the comparison between the two? Or private equity, when it's compared to public equity, what are features that are different? You find that private equity, it's less liquid. This is because it's not public. And then you find that the shares price, it's negotiated by these investors. It's not kind of established through the market forces. It limits a firm or more limited firm financial disclosure because it's not going to public. Actually, we are saying here the private equity, it is less liquid. And then you are saying the share price is negotiated by the investors and not determined by the market forces. There is limited market, or could it say there is limited disclosure because it's private. So there is limited disclosure of their transactions and even their information. And also it has lower reporting costs because of it's less uniformity with their reporting requirements, because you find that when a company is going for an IPO, there's a lot of, it's a lengthy process whereby there is issue of book building, the issue of preparing the prospectus. So all those preparation and process, they take a lot of time and also cost. But here, there is less reporting cost because it's more of a negotiation between one investor and another investor. So there's no this reporting cost because they don't have much to disclose in their informations. And lastly, we have the aspect of it's weaker compared to public equity. It's weaker. It's weaker compared to public equity. But again, its returns are potentially greater. So again, you can say that returns are greater. The returns are greater compared to the returns of a public equity. So let us look at the different types of private equity that we have. Types of private equity. We have what we call venture capital. Number two, we have the leveraged buyout firms. So what's the venture capital? Also, actually, number three, we have what we call the public investment in private equity, what we call the PIPE. What we call the public investment in private equity, commonly known as. So let us look at the venture capital. So what's venture capital? This refers to the capital provided to the firms in their early life cycle, what we call startups, to fund their development and growth. So it's a kind of fund or capital provided to a firm by an investor in its early life cycle, what we call startup. And who provides this kind of capital is called the investors. But before they do so, they must be convinced that this business is worth it, the investment, because after all, they will have to first of all get their initial capital, which the initial outlay which they invest in the business. So first of all, the business must be really promising, if I can say so. Venture capital financing of various stages of a firm, preferably what we call the seed or the startups capital, when in its early stage. And then the investors can be a family of wealthy individuals or what we call the private equity firm. So these are the people or investors who invest in a business which is in its early life cycle or in its seed or startup stage. The business must be promising because initially they must be convinced that their capital is going to be returned. Number two, let us look at the leverage buyout. This is where I find that number two, buyout. You find that some investors can buy the whole firm. You buy all firm by use of debt. An investor or investors could be another firm. They buy all the existing firm by use of debt. That is what we call the leverage buyout. Now, when it happens that the people who are the management or the executives, they are the one who want to buy the same firm by the use of debt, then we call that an MBO. This is LBO. This is management buyout. So the leverage buyout is whereby the investors buy the all or the firm by use of the debt. And we have seen that when you find that the executive or the management of the same company wants to buy it by use of debt, that is called a management buyout. And then the firms in the leverage buyout usually have cash flows which are adequate to service the issued debt, or have undervalued assets that can be sold to pay the debt over time. And then lastly, you have the publicly investment in private equity. And this is a public firm that needs a capital quickly, sells private equity to investors. Find that. Number three, you have said you have the PIPE. The publicly investment in private equity is a form of, again, a private equity. And you have said that this is where a public firm which is, or rather which needs some money or capital quickly, it can sell its shares to an investor, or it can sell its shares or equity to an investor, because it's there's company, a firm in need of capital quickly. You find that going to IPO, it's a process. You can take even some months. But now this firm needs money urgently or quickly. So what will it do? It will sell its equity to a private investor or to other investors in what we call public investment in private equity. So let us continue. And now let us look at the equity market transactions. We find that all these, what we have been looking at, these types of equity investments, all these types of different types of equity, be it a private, a public, be it a preferred share, a preference, convertible, redeemable, they all take place in an equity market. So in an equity market, so this is where we have these all transactions. So we find that when a security is traded, a dealer operating as a market maker quotes a price at which he or she is prepared to sell. This price is called the offered price. This is the price, the offered price, which is quoted by a dealer or a market maker at which he or she is prepared to sell the security. And then the price at what she or he is willing to sell or buy is known as the bid price. This is the quoted price. And this is the price that she or he is willing to sell or buy security. And then you find that there will be a difference between the quoted price, which is the offer price or the ask price, and the bid price. This is also called the ask price. Now, the difference between the two is called the spread. The spread is the difference between the ask price or the offer price and the bid price. Now, the spread could be narrow or it could be wide depending on some factors. Now, these factors include the order cost, the inventory cost, competition, volume, and the risk of the security. So what is the order cost? The order cost is the cost of processing the orders, including this process of processing the orders, and then include the charging cost and also the service cost. Also, you have the inventory. This is the cost of maintaining a specific inventory, the cost of maintaining a security. And also you have competition. So you find that the larger the number of market makers, the greater the competition, the narrower the spread. So we find that when the money makers and the dealers, so what we call the market makers, are many, there is high competition, which leads to a narrow spread. This spread, it essentially means like a profit. It's more of like a profit. So, and then let us look at the volume. The volume, the larger the trading volume, the more liquid the shares are, the less risk the prices change. So when the volume of the securities are high, there is less risk. High volume, less risk. and the share price, there's less change in a share price. It's a less change in its price. The risk, the more the riskier the share or the security, the more volatile the shares are, and therefore the higher the spread, higher the risk, leads to higher spread. So you have said that, first of all, in the transaction which take place in the equity market, there must be an order, and this is placed by the investor through a broker. Actually, we are going to, in our subsequent lectures, we are going to look the market, equity market players, where we have people like the broker, we have the dealer, we have what we call the market maker, we have the special, and also we have what we call the arbitrageurs. So we find that when an investor wants to invest in a certain security, he or she will place an order through a broker. Now, an order which has been placed through a broker is to be executed by the broker depending on how favorable the market is. Now, you have different types of orders. You have the market order and the limit order. Now, what's a market order? A market order is the order that requires that the shares are treated at the most favorable price. The securities here are treated at the most favorable market price. And then we have what we call the limit order. This is where it places a limit on the price which the shares can be bought or sold. So here, this specific order, which will place a limit at which price securities will trade, either be bought or buy or sell. So there is a limit at which the price the securities one is going to buy or sell. So you have different types of limit orders. We have the buy limit order, the sell limit order, the market if touch order, you have the stop order, the fear or kill order, and the open order or the go until cancel order. So let us look at the different at each one of them. Number one, the buy limit order. This one, it specifies the price of purchase, or it's like sets a limit at what one is going to buy the limit. That is, if the price is at that limit or below, it sets a level or a limit at what one is going to buy the order. So if the price is at that limit or below, then it's going to buy the shares. For example, if it says you want to buy a share at 50 shillings, then if it's at 50, it's going to buy. If it's at 45 or even 20, it's still going to buy. But if it goes beyond this 50, then it's not going to buy. And then number 2, the sell limit order. Here, one places a limit at what price he or she is willing to sell the security. If the price or that level is reached at or even it's above. So it sets a limit of 50 to sell. So it will sell if the price is at 50 or above 50, even at 100. And then we have what we call the market if touched order. Become a market order if the share price reaches a particular level. This one becomes a market order if the share price reaches a certain level. Becomes a market order if the share price reaches a certain level. Then we have number 4, the stop order level. This is whereby it is also an order that becomes a market order if there is a trade in the market at the particular price. This is also an order that becomes a market order if there is a trade in the market at the particular price. So it involves selling of shares after the price has fallen to a specific level, or buying after the price has risen to a specific level. Then you have the fill or order kill. Fill or kill order. It is to be cancelled immediately if not executed. This one, it's cancelled immediately if not executed. And then the open order, or what we call the good till cancelled order. It is the order that is or remains in force until it is specifically cancelled by the investor himself. It is an order that remains in force till it is specifically cancelled by the investor himself through the broker. So let us look at what we call the margin trading. These are a type of trading that takes place in equity market transactions. This is a scenario whereby an investor wants to invest or buy shares in a certain firm or in the stock exchange, but he does not have enough money to do so. So what he does, he will borrow money to facilitate his purchase of those securities, but again is going to use the same securities as, or shares as securities as or as collateral. So investors can borrow cash to buy securities and use the same securities as collateral. This kind of a transaction is called margin trading or buying trading. Stroke buying trading. This is a scenario whereby an investor can borrow money or cash to facilitate a transaction of buying securities, but again he's going to use the same securities as collateral. So this money that is going to borrow is going to borrow money through a broker. Then the broker will borrow money on his behalf from a bank. So there is an issue of interest here to the bank. So the funds that are borrowed to buy the additional stocks are provided by the broker, who in turn borrows from a bank. So in order for this kind of transaction or trading to take place, there must be what we call a margin account This is an account that an investor creates so that it will enable him or facilitate him to take place or to carry out this kind of trading. So a margin account, this is account with which the investor creates with the broker so that he will able to, or will it will enable him to carry out what we call margin trading. Now again, you find that in this margin account, the investor will have to deposit an initial amount of money. There is an initial amount of money which is deposited in this margin account, what we call the initial margin. So we find that again that the stock exchange regulation sets the initial margin requirement, which is the proportion of the total market value of shares that the investor must pay as an equity share, and the remainder is borrowed from the broker. So this is the initial margin. This is the, as I have said earlier, this is the amount that the investor is going to deposit in the account. That's the margin account. Now this money is going to be used to buy in the stocks, but now it could be 50% of the total cost of shares. Now the other 50% is going to borrow from a broker through a bank, or from a bank through a broker. So there must be a deposit in this margin account, what we call the initial deposit. And then we find that in order to reduce the possibility of default, stock exchange also have set regulations, or they have been able to establish what we call the maintenance margin requirement. Now this is the minimal maintenance margin account annual requirement. This is the minimal proportion of the equity in the stock or in the investor's margin account, the total market value, what we call the initial, the minimal, the maintenance margin requirement. This is the minimal proportion of equity in investors' margin account. So you find when one is carrying out this type of trading, what we call the margin trading, there is this issue of borrowing money. Now this borrowing of money, it can either magnify your profit or your loss. So there is this aspect of return on investment. In this type of trading, there's an investment. So for you to see that, or to calculate your return on investment, we use this formula. That is the selling price of the share minus the purchasing price of the share. You subtract the interest added to commission plus the dividends, if n, divided by the owner's equity. This is the selling price. This is the purchasing price. This is the interest, because you borrowed money from a bank, then you are going to pay in a certain interest to the bank. There's a commission, probably is paid to the broker, and the issue of dividends, if n, and then you divide by the owner's equity. By doing this, you are able to see if this kind of investments has a return or it does not have a return, because sometimes it may not have a return depending on at which level, or to which level the market price is falling. And then let us look at what we call the margin call price. The margin call price, you find that all this margin trading, the shares which were held as collateral by the broker, they are not supposed to fall under a certain level of their market price. So you find that this is the call, this is all the margin call price. This is the price at which, when the price of the securities falls below, the investor will be required to top up the margin account. So you find that if the securities price fall below a certain level, the investor will be required to deposit a certain amount of money to his margin account. The investor receives a margin call from a broker specifying the amount of cash that is not supposed to deposit in the margin account. So for you to determine at what level or at what price that you are going to receive this margin call, if you are going to receive it, you use this formula. This is the market price per share into brackets 1 minus the initial margin and 1 minus the maintenance margin. Maintenance margin we divide here. This is the initial deposit, that one, or a minimal proportion of equity in the investor margin account. So let us look at an example of where we have. Let us calculate an example where we are going to look for the return on equity. And again, we are going to use our past papers. You can look at November 2016. November 2016, question 1B. November 2016, question 1B. No, it's 1C. It is question 1C. And it reads, Philip Kisero purchased 100 shares of Kilimo Limited at a price of 32 shillings per share. The shares were bought on 75% margin. 1 month later, Philip Kisero had to pay interest on the amount borrowed at the rate of 2% per month. At that time, Philip Kisero received a dividend of 50 cents per share, and immediately after that, he sold the shares at a price of 28 per share. He made a commission, or rather, he paid a commission of 5,500 shillings on the purchase and a commission of 500 on the sale of the shares. So that you are required to calculate the return on equity on that month that Kisero did his transaction. That's November 2016 question 1C. So first of all, for you to find the return on investment, we are going to use this formula. So you have said that the formula is the return on investment is equals to the selling price minus the purchase price, you minus the interest plus the commission, you add the dividends, then you divide by the owner is equity. So from that question, the selling price is equals to 28 shillings. The purchasing price is equals to 32 shillings. And then we have the number of shares that Philip bought first. There were number of shares there were 1,000 shares, sorry, 1,000 shares. A 1,000 shares at 32 shillings. and he sold the shares at 28 shillings. We have the issue of interest. Interest of 2% per month, and then there's a commission, of 500, and also you receive dividends of 50 cents per share. So there's a commission of 500 shillings, and then there's a dividends of shillings 0.5 per share. So you have everything that we need to do our calculations. So first of all, again we are told that he used or he borrowed money which were at 75%. No, 25%, because he bought on a margin of 75% margin. That was 75% margin, because no, or it means that in these 32 or when he was buying these shares, he used his own amount who was 75%. The rest, which is 25%, he borrowed the money from a broker. So let us do our calculation and determine the return on investment. So find that. So for you, let us try and find out the total cost of purchasing these 1,000 shares at these. So the purchases will be 32 times 1,000. So it gives us 32,000. But again, we are told that he used a 75% margin. So meaning that 75% of 32, 75% times 32, you find that it is 24, sorry. It's 24 shillings, meaning that the 25% that he borrowed, we can find it. So 25% times 32, find that he borrowed 8,000. This is the money that he borrowed to facilitate his transaction. You can also take 32, subtract from 24, find it's 8,000. So this is the money that he borrowed. So the total purchase now will take, because there's an issue of a commission, they will take, that is 32 minus 500, the commission, so it's 31,500. This is the total cost of purchasing the shares by Philip Kisero. But again, he received dividends. He received them. The dividends were paid at a rate of 0.5 per share. So it is 0.5 times the number of shares is 1,000 shares, and you find it is equal to 500 shillings. So the 5 final shillings. So what you do, you add the dividends back to the total purchase cost. So you find that it's 31,500 plus 500. You find is 32,000. So this is the total purchase cost after you have added back the dividends that were paid. Now, the interest that was paid, so you need to look at the interest here. This formula, you have interest. The interest is paid at a rate of 2% per month. So interest, that is 1.0, the interest paid to bank is equals to 1.02 by the amount of money that was borrowed. And we say that was able to borrow 80,000. So by 80,000. And you can find that this is equal to 8,160. This is the interest that was payable. So for you us to find the return on equity, or we will first of all calculate the amount of money that this person is going to remain with after he has paid the commission and the interest. That is, if he's going to sell, the selling price per share for him is 28 shillings per share. And then again, we have the number of shares is 1,000 shares. So that is 28 shillings by 1,000 shares. You find is 28,000. Again, you are going to subtract the interest that's going to pay, or rather the interest plus the amount of money that's going to pay to the bank. That is 28,000 minus, he borrowed 8,000 plus the interest of 160, that comes to 8,160 minus again the commission that is going to pay. So you find that its wealthy, or the ending wealthy of this Philip Casero will be 19,340. This is the money is going to remain with, and again he spends this amount of money to do what? To purchase the shares. So in order for us to determine if there was a positive or a negative return in this kind of investment, we take the the selling price, which is 19,340. We subtract the purchase, which is 32. Then we divided by 32, which is the owner's equity. The issue of interest and the commission you have tackled under this, so it's well taken care of. So by doing this, you find that when you subtract this from this, you find it is 12 minus 12, 660 divided by 32. And then you find that it's minus 0.3556%. So you find that here the return on investment was 39.56% but it's negative. So actually it made a loss, not a profit. I hope it's understood. Again, let us try to do one illustration of the coal price. At what price that an investor is going to call or to receive a call price from the broker, instructing him to deposit a certain amount of cash to his margin account. Let us look at an example. You can say that an investor purchases a stock for 40 shillings per share with an initial margin requirement of 50%. Then the maintenance margin requirement is 25%. Then you are required to calculate the price at which the investor will receive a margin call. Calculate the price at which the investor will receive a margin call. You are told that an investor buys a stock for 40 Kenyan shillings per share with an initial margin requirement of 50%. So this is the buying price. And then 50% is the initial margin requirement. And then we have a maintenance margin of 25%. 25% is equals to maintenance margin. So you are required to calculate the price at which the investor will receive a margin call from the broker instructing him to deposit a certain amount of cash to his margin account. So we are going to use the formula that we wrote earlier. The formula is there. That margin call price is equals to market price per share into brackets 1 minus the initial margin then you divide this by 1 minus maintenance margin. So what is our market price per share? It is 40 shillings. So it's 40, 1 minus the initial margin here, we are told is 50%. So it's going to borrow 50% because he needs to have 50% as an initial margin, and the rest it will be borrowed from a maybe a broker, the 50%. So it is 50%, that's 1 minus 50% divided by 1 minus the maintenance margin, we said is 25%. So this is 40, 1 minus 0.5 divided by 1 minus 0.25 is equivalent to 40 by 0.5 divided by 0.75, which is equivalent to 26.67 shillings. Meaning that if the share price is going to go beyond 26 shillings and 7 cents, that is, if it's going to be below this, then the broker will call the investor, instructing him to deposit a certain amount of cash to his margin account. Also have another illustration. I think it's May 2018, question 5D. May 2018, question 5D. May 2018. May 2018. That's May 2018, question 5D, and it reads that the investor wants to buy shares at 35 shillings per share. They provide a maintenance margin of 35%. Then you are said to calculate the margin call price, given that you need to find the owner's cash investment. So you are provided with market price per share, it is 35. Maintenance margin, it is 30%. Then you are given an initial margin of 50%. Initial margin of 50%. Then you are told to calculate the call price. Again, we use this formula, so we substitute the values. So it is 35 shillings per share, 1 minus the initial margin, which is 50%, that is equivalent to 0.5, divided by 1 minus maintenance margin of 30%, which is equivalent to 0.3. Now this is 35 by 0.5 divided by 0.7. Then you find that this is equivalent to 25 shillings, equivalent to 25 shillings. So this is the price at which the call price, the broker is going to call is going to call the investor, instructing him to do the call, deposit a certain amount of cash to his account. I think that marks the end of today's session.